A major country is imploding. I'm your host, Steve Van Metre, and thanks for joining me today. And a major economic superpower is crumbling and on the verge of collapse. Let's head over to Bloomberg, where we picked today's story up as German business confidence falls as the economy already contracting. As the country rushes to wean itself off Russian energy, business surveys are highlighting Germany as a weak spot within the major powerhouse of the Eurozone, within the 19-nation Eurozone. Output already began to shrink in July and contracted again in August, as S&P Global said in a recent release. The outlook for the coming months is clearly pessimistic, and uncertainty among companies remains high. Economic output is likely to shrink in the third quarter. And this is important to understand because when you see shrinking economic output, you tend to not get inflation. So you tend to get disinflation, and with enough contraction, you can get outright deflation. So when you see this, not just in Germany, but in Asia, in the Eurozone, the US, when you see the contraction, think disinflation, and that's not good. The index is seeing the worst declines in the retail sector. This, of course, has to do with the high inflation rate we're observing in Germany, which is clearly weighing on the purchasing power of households, and is simply explained as people can't afford higher prices. And that, my friends, is also coming to America. The German economy gets another growth warning as trade volumes drop as a sign their economy is contracting. German exports and imports both fell in July as surging prices and the war in Ukraine threatened to send Europe's largest economy into recession, which I'll say is the best case, more likely a depression. The trade surplus sank to 5.4 billion euros from 6.2 billion euros in June as export dropped 2.1% and imports by 1.5%. Germany's statistics office said on Friday. Get this, goods sales to the U.S., the country's biggest market, fell by almost 14%. And here again, you see signs that the global economy is slowing down, and this is not inflationary. If demand from the U.S. is dropping, and that means exports from Germany to the U.S. are falling, that is bad news for the global economy. And look at what's happening. We see European manufacturers now are reeling from Russian gas shutoff as the energy crisis has left few businesses untouched. And get this, some factories may never reopen. The impact has pushed Europe to the brink of recession and threatens to inflict lasting harm on its manufacturing business. And should Europe go down, the one thing that shouldn't have lasting damage is your portfolio. I'll put a link up here to Portfolio Shield and description below. Unlike the U.S., Europe leaned on manufacturing and heavy industry to keep its economy chugging in recent decades. A bigger chunk of its economy comes from the likes of steel makers, chemical producers, and car makers. The factory closures come at a ruinous cost. Companies in energy-intensive industries say they face going bust this winter without government support. And complex supply chains in sectors such as the auto and food industries are getting gummed up, adding to the inflationary pressures just as pandemic snarl-ups show signs of easing. So what Germany is facing and other parts of Europe are going to face is a complete shutdown of their manufacturing base. And now that doesn't lead to inflation in the rest of the world. Sure, it means orders that might be directed to Germany and other parts of the Eurozone will get pushed to other countries, but demand out of the Eurozone is going to tank. And notably, what you see, industry is looking to the government for answers, but there's one thing governments and central banks can't do, and that's pull energy out of thin air. Germany to implement power to price cap with great speed as they hope to find some way to solve their energy problem, as Berlin is looking on how to push down heating and gas prices when they should be looking at how to get more energy. We will now push this through with great speed so we can relieve the burden on consumers as well as companies when it comes to electricity prices. Then that was said by Schultz on Tuesday on a speech at the BDA Employers Association. And the reality again here is they can't create energy out of thin air, and failed energy policies and, of course, the addiction to Russian energy has put Germany and Europe in a precarious situation to the point where people are just talking about them having a recession. But in reality, if you start shutting down major manufacturers, you're not going to see a recession. You're going to see a depression. And yet many people look at this and say, yeah, well, that's just too bad for them. It doesn't mean anything to me. And yes, it does, because when things go wrong in Europe, that means things are going to go wrong in Asia and the U.S. We are not immune to when things go bad there, and you can see now they're getting worse as German services sector stumbles as soaring inflation hits confidence. And S&P Global's final services purchasing managers index for August fell to 47.7. Remember, 50 is unchanged, so see now a contraction in the services sector. That was also lower than the late August flash estimates of 48.2. Facing persistently strong cost pressures from higher energy bills and rising wages, services firm continued to take on new staff to address capacity constraints, but employment growth lost momentum and was its weakest in a year and a half, and that will change, and you'll see layoffs are coming next. The final composite PMI, which tracks both the manufacturing and services sector that together account for more than 2/3 of the German economy, fell in August to a final reading contraction at 46.9 from 48.1 the month before. And here's the evidence that you're waiting for is the U.S. immune to this? And the answer is no. And here you can see that the real gross domestic product for Germany in blue on a year-over-year rate of change, and against the U.S. gross domestic product in red on a year-over-year rate of change. And notably, what do we see? The blue line leads the red line, suggesting that where Germany goes, the U.S. follows. And when we talk about the U.S. now, well, let's take a look at what's going on in the U.S. factory sector today with producer prices. The U.S. producer prices fall for a second straight month as fuel costs retreat, and this isn't a good sign, although while many people will say it is, it's not, as costs excluding food and energy increased 0.4% in August. The producer price index for final demand decreased 0.1% from a month earlier and increased 8.7% from a year ago, which was slowing from the month before. Excluding the volatile food and energy components, the so-called core PPI climbed at a larger than forecast 0.4% in August and was up 7.3% from a year earlier. And the way this gets interpreted is, well, this means price pressures are coming down. That's a good thing. It also means demand is falling, and as demand goes down, well, that means layoffs are going to go up. And what we're going to see now is a continued trend in lower producer prices, because the biggest input, the biggest factor in U.S. producer prices, well, it's energy. And here you can see the producer price index in blue against crude oil prices in red, WTI, West Texas Intermediate, both on a year-over-year rate of change. And notably, what do you see? You see red, or energy prices, falling and leading the producer price index. You see it here in the 90s. You see it going into the recession and dot-com bubble. You see it here again. And in fact, in every instance, you note that, again, energy prices lead producer prices, suggesting that what we already know today is that producer prices are coming down. And we can see that in the data because it tells us energy was the leading reason we didn't see producer prices go higher. And here you can see in the report, energy reported a -6% drop in prices in the sector, leading the rest of it, suggesting that where energy goes, the rest will soon follow. And looking at CPI and PPI, we have to look at inflation now as the biggest jump in U.S. rents since 1991 keeps the overall inflation picture high. But what we can glean from this is the producer price index tells us that inflation is indeed cooling down. And as long as crude oil prices either stay at their current level or head lower, it tells us that we're going to see a big drop in not only producer prices, but then consumer prices. But what's holding consumer prices up is this rent issue. As shelter costs have risen at a rapid pace in the last several months, and moderation should begin next year, but inflation will stay high. Well, we'll see about that, because what we can note here is when we look at the consumer price index in blue with just a focus on the rent of primary residence, and then we overlay that with the broad consumer price index, what we can see is there are trends where broad consumer prices start to fall, and there's a lag where you see rent prices still hanging high, and then they come down. So it's fairly normal that we see consumer prices start to fall against rising rent prices. Again, a lagging indicator. And our chief strategist, Jeff Snyder, well, he talks about that in his daily, as he says the primary reason outside of food prices was the acceleration at the core rate, which many are mistaking for actual inflation pressures. On contrary, the increasing pace was due entirely to shelter prices, specifically owner's equivalent rent, he says, the lagged effect from last year's housing price bubble. And if you want to know more about what our chief strategist says, our energy expert Tracy shoe chart, and our momentum report that I put out. Well, be sure to click on Markets Insider Pro. There's a link in the description. It's free countdown for a limited time, so get on it, check it out before we go paid. And so now you can see that when things go wrong in Germany, it means they're coming to America, and that's not going to be good for the U.S. economy, which has already seen signs of a slowdown, telling us that we're not just seeing the Europe headed into a recession. We're not just seeing Asia head into recession. We're seeing the world head into recession. And if things go really bad in Europe, they could be in a depression and take the rest of the global economy down with it. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.